changed for you in 2011? Did you start a new job or leave a job behind? Did you retire? Did you start a family? If some notable changes occurred in your personal or your professional life, then you'll want to review your finances before the year ends and the next one begins. Even if your 2011 has been comparatively uneventful, the end of the year is still a great time to get cracking and see where you can plan to save some taxes and or build a little more wealth. Tax loss harvesting is the art of taking capital losses, which is selling securities worth less than what you first paid for them, to offset your short-term capital gains. You might want to consider this move, which should be made with the guidance of a financial professional that you trust. In fact, you could even take this a step further. Consider that up to $3,000 of capital losses in excess of capital gains can be deducted from ordinary income, and any remaining capital losses above that can be carried forward to offset capital gains in upcoming years. So you might think of triggering excess capital losses in 2010 and using the losses to shelter future long-term capital gains that could be taxed at a higher rate. If you're in the 10% or the 15% tax brackets, your capital gains tax rate is 0% for 2011 and for 2012. If you fall into these tax brackets and sell assets that you have held for at least a year, you won't pay any taxes on capital gains. For 2011, the 15% bracket tops out at taxable income of $34,500 or less for individuals, $69,000 or less for joint filers and qualifying widows/widowers, and $46,250 for heads of household. If you do itemize, great. Now would be a good time to get the receipts and assorted paperwork together. Besides a possible mortgage interest deduction, you might be able to take a state sales tax deduction, a student loan interest deduction, or deductions related to a job search, volunteering expenses, energy-efficient home upgrades, and medical expenses. There are so many deductions you can potentially claim, and now is the time to meet with your tax professional so that you can strategize to claim as many of them as you can. If you can do this in November and December, that will lower your taxable income. Do it enough and you might be able to qualify for other tax credits or breaks available to those under certain income limits. How about making a contribution to a charity or some other kind of 501c3 nonprofit organization before 2003 ends? In most cases, these gifts are partly tax deductible. If you pour some money into a 529 plan on behalf of a child, you could get a deduction at the state level. This, of course, depending on the state that you choose. Of course, you can also reduce the value of your taxable estate with a gift or two. The federal gift tax exclusion is $13,000 for 2011 and 2012. You can gift up to $13,000 to as many people as you wish this year, with the understanding that you have a $5 million lifetime limit before you are actually hit with gift taxes. Now, please note that that $5 million lifetime limit is scheduled to reset back to the previous $1 million ceiling in 2013, and that reset could happen sooner. You still have time to make a charitable IRA gift, although it may seem less crucial with the lifetime gifting exemption at the current $5 million. Taxpayers 70.5 or older can arrange a direct transfer, a rollover, from their IRA trustee to a qualifying charity, nonprofit foundation, or nonprofit organization. This tax-free donation of IRA proceeds can aid the charity and allow you to take credit for a qualified charitable distribution on your 2011 1040 form. Charitable IRA rollovers are slated to disappear in 2012 unless Congress acts to save them. Before 2011 ends, why not take a moment to review the beneficiary designations for your IRA, your life insurance policy, or your retirement plan at work? If you haven't reviewed them for a decade or more, which quite frankly isn't uncommon, double check to see that these assets will go where you want them to go should you pass away. Take a look at your will as well to see that it remains valid and current. You know the argument here. Converting a traditional IRA to a Roth could potentially bring you long-term tax savings, assuming taxes go higher in the future. Here's the big question. Will the projected tax savings over your lifetime exceed the tax that you will trigger from executing the conversion? Now, no one has a crystal ball, but various possible tax outcomes could be reviewed before any move is made. If you went to Roth this year only to see the balance of that IRA diminish, some IRAs have, you could always recharacterize it back to a traditional IRA. Should the markets really take off next year, you could convert that recharacterized traditional IRA to a Roth again. As you have to wait 30 days after recharacterization to do another conversion, recharacterizing a Roth back to a traditional IRA could be optimal before December rolls around. Talk with a financial or tax professional now rather than in February or March. Little year-end moves might help you improve your short-term and long-term financial situation.